Yeah, I'm losing my edge.
Let's get into a precious metals case study here
All right,
today.
let's do it because today's the day to do it.
Yeah, precious metals have been moving like mad. And it's interesting because when you talk about an equity market that's moving like mad, it's usually, okay, S&Ps, if they got up to 3,300 and then dove back down to 2,700 like they did earlier this year, there's not really a historical case for that because they've never been as high as they were before that dive. So if you went back to 2008, the last time we saw a significant stock market crash, S&P 500 is nowhere near where it is today. It's this price that has drifted upwards since stock markets were invented in the 1800s, early 1900s, and you can't really do what we're going to do here today. What's nice about commodities, specifically something like gold or crude oil, which we've done in the past, is they tend to see the same prices decade over decade over decade. There is
That's
trending,
a great point,
of course, but they have, that's more of a pure mean reverting product in the long term, right, Pete? Where like you could say gold has like an average price of like 800 or 1,000, and there's a ton of back and forth, right?
Yeah, there's not the way you would associate positive drift in equities with things like metal or crude. They're all, there's inflation, so they should all rally because the cost of money is. We haven't had inflation in 10 years, so I think you make a very good point that that bias is not seen in terms of there's not all other things being equal. Equities pay dividends, so there should be positive drift to them. I don't think that's the case at all in any of these products.
Yeah, so it is an apt market to do a long-term case study in. And unfortunately, the small precious metals has only been around for 40 trading days here.
Yep.
So you can't really do a case study in this index in particular. But what's nice is as we look at this market rip through historic highs going back to, we have index calculation going back to about 2016. And these are the highs in this product. We can break it apart to its component parts here. It's a very simply structured product that's at this moment about 64% gold, 30% silver, and just a little bit of platinum action in there. And we can say, all right, well, let's look at gold. Let's look at silver, which we have prices for going back to 1990 when futures started trading on these markets. And let's look at them individually. And then I want to package them back up and see what movement has been like in this case study that we're diving into in what would be the small precious metals. And the case study that we're diving into here, Pete, is going to be this region right here, specifically 2011. But we're going to look at the last time gold was as expensive as it is now. It's only been to these price levels once before historically, Pete. And this is the extreme. And who knows if in the next year it's going to look like this, where we hang around 1,700 to 1,900 and then eventually come off. Could put new highs in gold, could get as high as 2,000. There's a lot of premium in the calls up to 2,000 and even 2,100. Definitely could get up there. But I want to do this case study on gold and silver going back to 2011 because of this idea of, gold very cheap in the early days of futures trading, hanging in just the mere hundreds. But
Chris,
over the last decade and a half, gold very much mean reverting between just below $1,000 and getting up to as high as 1,800 or 1,900. So we're going to do this case study on 2011, but let's get some metrics in mind here. We're looking at realized volatility. Average realized volatility over the last 3 decades in gold, Pete, 15%. The average daily move in gold over the last 3 decades, about $10. On a weekly basis, 22. We got the same numbers here for silver, slightly higher realized volatility at 26%. Daily move about 30 cents, weekly move about 70 cents. And you can see here, we've talked about this a lot, but a very different place where silver is in. But keep in mind here, like we're about to see, this silver market lagged gold prior to our case study of 2011 here, where silver skyrocketed. If we bounce back and forth, you see gold kind of climbing, climbing, climbing prior to 2011, while silver's just hanging in here, and then boom, it takes off.
Right.
And it's we've talked about this before, and kind of made this debate over whether or not we debated it as recently as 30 minutes ago, whether or not silver is cheap or expensive here. That's not what I'm trying to do today, Pete. I just want to talk about volatility and movement vis-a-vis these three metrics for the last 3 decades, but then in particular, the last time we were right here.
I'm sorry. Yes.
No, I know you got a lot
Because
going on.
I apologize.
Dog and yeah.
So you know what? I think it's interesting to see this propensity for divergent movement. I mean, this is what creates the interesting tradable opportunity for us. So I like going back and taking a look at, this Fridays are usually a time where we take a step back, put a little context around opportunity. And I like this is the perfect time to do this with our precious metals.
You're probably not opening a new silver position here on the Friday close, but it is good to kind of size up what this market has looked like in the last 3 decades on an average day, week, or volatility basis. And then last time this market moved like it's moving now here in 2011, look at the difference in these metrics. You've got an average day that is more than 3 times what it was by normal standards, an average week that's more than 3 times what it was by normal standards, and a realized volatility that's almost doubled. So when you're trading options on silver, keep that in mind, that you are going to want to be picky and demand almost twice what you're normally getting for silver strangles, calls, puts,
right,
iron condors, anything that you're looking at. And then also from a scalping basis, the last time that they moved like this here in silver, you can't be scalping a 30 cent or 40 cent range if this volatility continues, because as we've seen this week alone, a lot of days more than $1 in the upside direction here for silver, a lot similar to 2011 where we're doing this case study, and a similar thing for gold here, Pete. But what's interesting, and I'm glad that this case study confirms it, is gold right now here in 2020, amid the more expensive prices than 2011 here, as gold sits at about 1900 in 2011, just barely got above 1800. What's funny though is that the realized volatility in gold right now, Pete, is only at 11%.
Yeah.
It's been a very calculated, slow grind.
Agreed.
In gold to these highs. And you can see with the case study here, of course, you got the jump in volatility, but I mean, not nearly close to double the realized volatility in 2011, and just a little bit more than double the daily and weekly action relative to silver. It's more than 3 times that. And this is something that you have talked about in the past, Pete, and I'm sure you're not surprised about, which is when volatility picks up in metals and we get back to these highs that we saw in 2011, where we're doing this case study, silver is the more volatile beast that can really kick your butt on a daily basis, right?
Absolutely. And you know what? Even when we were down at $14 silver, we saw that I don't know if it's the right term, but the volatility term structure stay at a multiple of gold. Sometimes we see that get closer depending on, but this is interesting. Contract highs in gold, lifetime highs, as you said, in gold. Silver, what, a third of that lifetime high? But silver still maintaining that propensity to have outsized movement. So there's nothing new in that. The degree of that outside movement is what oftentimes creates interesting tradable opportunities. But you make a good point that there's a reason why that term structure stays. That term structure volatility stays as rich as it does comparatively. You would make the argument here at this point is, well, gold's too cheap for where it is, basis where silver vol is. I don't think you can look at it that way. I think you take it as a metric of propensity. In other words, propensity of what it can do. I think it's demonstrated that very clearly over the last 3 weeks. It demonstrated it 6 months ago with a move from 14 to 18. Same
Yeah.
thing.
No, this is why I really advocate for working commodity markets into your tool bag. Is that this is a really beautiful concept that you can go back to 2011, where things were very different. The stock market was at a very different price. Sentiment was very different. Just recovering from the biggest stock market crash they'd had in decades. And what's funny is the price of gold and silver, silver not so much, but the price of gold going back to that time, right where we are right now
Right.
at this very different stage, but gold moving almost exactly like it did at that point, which is to say that volatility not screaming off the page even at these highs.
Right.
And it's funny because, yeah, you've got to realize volatility in gold at around 10 or 11% right now, which is underperforming historical metrics of realized volatility, but showing this trend of just because we got the price extreme in gold doesn't mean that it's moving by 30, 40, $50 per day. Whereas you go over to silver, and silver's realized volatility right now is above 30%. So you are seeing that jump up in realized volatility in silver, even though the price hasn't climbed to $50. It's just nice to see in these commodity markets, stuff can be so different. It could be a decade's
Right.
worth of removal from where this case study is done, but everything is still pretty much the same. The prices are the same in gold as in 2011. The
See,
volatility
right.
not screaming off the page, the same kind of trend. Silver, different price, but exhibiting that greater volatility here. And it's something that you have to work into your trading, right, Pete? Like you have to
Agreed.
be a little bit more patient with your silver entries and more aggressive with that management. Where gold, just like we saw this week, Pete, we've traded gold and silver this week. In gold, you can be a little bit more, I don't want to say lazy, but you can, like you like to say, give the trade a little bit more rope than silver. Silver, there's not a lot of rope you can give when it starts to heat up.
No, and I think this is a good we always talk about the wariness of going too far back in time and uh, trying to assign, okay, this is the tradable opportunity. But I think context around this is really important, and this speaks to the $23 or the $25 silver is rich from where we were a week ago, but is it really rich? Depending on if you went down to a 15-minute chart, you'd say, boy, this has been like a parabolic move to the upside.
Yeah.
It's good to put context. It doesn't change what you're looking to do, but it puts context around you respect the propensity for movement here, and it
Yeah.
exists whether we're at the exact same level or we're up near those contract highs.
And
I think that's a solid takeaway, and I like going back to this looking at this divergence in terms of where everything was in 2011, 9 years ago, almost 10 years ago, and now is not leaning me to a trade idea, but I think it's respecting the idea of what I
sure.
look at in terms of what's cheap and what's rich in a more granular basis. I love putting context like this back in. It keeps you grounded in what the potential is and helps you, I think, identify better opportunities and what is a better opportunity and what should I expect out of that opportunity?
Yeah, and the next step is okay. Well, you show me all these volatility metrics and have now hopefully taught people to be a little bit more, worry about these kind of trading ranges, not the normal, because it
Right.
looks like we've slipped into the abnormal like we did in 2011 for trading metals. And yeah, the next step is okay. Will this current environment shake out like it did in 2011? And if it did, Pete, you saw this lagging run up in silver relative to gold. Sorry, as gold was doing it, was running up all the way since 2010. Saw that rally, whereas silver hung behind and then really ripped. If history does repeat itself, then we're only seeing the first days of silver volatility. I'm
Right.
not predicting that history will exactly repeat itself, but that's the next step is kind of formulating your ideas around that, and you see gold through those highs. What I would do, though, now that we do have this small precious metals product in 2020, is I think this is a much better place to take that context and apply it to strategy, because here you've got, and I was able to kind of create implied prices for this index back in 2011, and you see the same jump up in realized volatility to kind of a middling extent between gold and silver, where you see a significant jump up, more than gold, but not as much as silver. And then you see the daily range, more than gold, but not as much as silver, expanding, and same as the weekly range. What's different, though, and why I would advocate for this product is these are daily ranges of, at the most volatile points in 2011,
Right.
$1.40 on a daily basis, on a weekly basis, $3.40, a little bit over $100 and a little bit over $300. Pete, what is a daily range in the silver contract here of a
Recently,
dollar? I mean, that's
75, of a dollar, $5,000.
yeah, $5,000 there, and even the smaller contract that's over
1,200, yeah,
over $500.
$1,250. No, it's
Oh yeah, yeah,
a
you're right. It's
quarter
not
the
a
size,
tenth.
not a
It's
tenth
yeah,
the
it's
size. Yeah.
a fifth the
Just
size
not to
there.
make it more complex, but
Yeah, but yeah, over $1,000 there in 2011. So it's nice. Now you've got this new product that you can apply this context of 2011, this case study, to here in small precious metals, because when things heat up, when these metals start to heat up, man, they can move. And you see that here in small precious metals, normal movement relative to that 2011 case study, but a much more manageable amount of abnormal movement in small precious metals. So you didn't have it in 2011. You got it here in 2020. If volatility continues, this is the product I would go for.